U.S. nat gas futures made a slight recovery on Wednesday, attempting to halt an 8-day losing streak as the market shifts to the October futures contract. The ongoing sell-off is largely attributed to diminishing weather-driven demand and a growing inventory surplus, with futures trading well below the 9-day moving average. This continued bearish momentum has emboldened short sellers, driving prices toward recent lows and raising concerns about further declines. The market's bearish outlook is primarily fueled by oversupply issues, made worse by high storage levels. The EIA recently announced a storage injection of 35 billion cubic feet for the week ending August 16, which was larger than expected, exceeding market forecasts and amplifying fears of a supply glut. Looking ahead, tomorrow's storage report is expected to show an injection within the 33 to 42 billion cubic feet range, slightly more bullish compared to the 5-year average of 43 billion. However, if the actual injection is closer to 33 billion, I anticipate a strong bullish response, as current price levels are particularly attractive to bullish traders. Additionally, today's price action hints that bulls are beginning to enter the market in anticipation of a positive outcome from tomorrow's EIA storage report, especially given that the next 3 reports are also projected to be quite bullish. Weather systems will bring showers and temperatures ranging from the 60s to 80s across the far northern U.S. Meanwhile, the rest of the country, including the East Coast, will experience very warm to hot conditions, with highs ranging from the upper 80s to 100s. Overall, national demand for energy will be high to very high over the next 4 days, before easing to moderate to high levels. WTI crude oil futures dropped by 1.3% on Wednesday, closing just above $74 per barrel, following a 2.4% decline in the previous session. The market was weighed down by a smaller-than-expected draw in U.S. crude stockpiles and ongoing concerns about weakening demand from China. Major banks have lowered their price forecasts, citing economic challenges in key markets like China and the rising adoption of electric vehicles, which are reducing fuel consumption. In Europe, diesel demand is expected to fall below pre-pandemic levels due to sluggish manufacturing and shifts in the vehicle fleet. These bearish factors are putting downward pressure on prices, although supply risks in the Middle East and Libya are preventing further declines. The latest EIA report showed a modest decrease of 0.85 million barrels in U.S. crude inventories last week, far below the expected 3 million barrel draw, contributing to the mixed sentiment in the oil market. If WTI oil settles below the $74 level, it will head toward the next support, which is in the $71 to $72 range. Today's price action indicates that the $1.95 support level remains solid, leading me to expect some consolidation above the strong $1.90 support in the near future. Moving forward, any catalyst, like an additional production cut, could rapidly push prices above the $2.10 threshold. As early winter forecasts emerge, prices might then advance toward the $2.50 resistance level, potentially setting the stage for a gradual rise toward $3 as the high-demand season approaches, reflecting the pattern seen in May. Please like, subscribe, and comment to support the channel. See you in the next one.